Welcome back to the traditional finance lesson. In our last segment, we'll think about the final step in the trading process, which is the payments. How do you actually pay for all the stuff that you buy? So, the first thing to notice is that processing payments is actually very expensive. This is a very difficult number to estimate, but old estimates in the US suggest that something like 3% of the GDP is consumed just by processing transfer of value. So US lags behind many countries in the payment system, and consumers frequently don't see the cost associated with payments. So as an example, when you use your credit card, even though you think that the amount that you are paying is directly the amount that's going to go into the merchant's account, the amount that the merchant gets is usually substantially less than the amount that you're paying. So in other words, when you use a credit card, the merchant is the one who essentially gets a discounted price. So in the US, there are multiple different payment systems. We call them rails, and they differ in speed, whether or not payments are made essentially in real time, or whether or not they take 3 or 4 days to clear, or whether or not they can be reversed. And also, the liability is frequently included into the payment system. So, money is usually described as performing 3 different functions or having 3 attributes. So, one is a stable store of value, 2 is a unit of account, and 3 is the medium of exchange that is easy and safe to use in transactions. To make some of those 3 characteristics concrete and explain why they are important for what we call money, just think about somebody who essentially has cheese. I love cheese. And wants to end up with pumpkins. So if they're in a world where they can barter directly with a person who has the pumpkins, they can go ahead and do it, and they can figure out what the exchange rate is between cheese and pumpkins. Somehow, there is a physical distance between them, and there are some other frictions that prevents them from bargaining directly. They have to go through a third party, and let's suppose that third party owns and values cows. So at this point, you have to have an exchange rate between cheese, cows, pumpkins, and everyone has to be comfortable that those exchange rates will remain static over time. If, however, there is a good that everybody will accept as a store of value, and everyone understands that the value of that good is compared to what they have and what they will own, then everything becomes much more efficient. You know the price of the cheese, the price of the cow, the price of the pumpkin, and you can move easily between one and the other. This is why those 3 characteristics of money are extremely important. It is also useful to notice that the money is a social institution. There is no reason why anyone would think that little bit of green paper with historical figures on them is a valuable thing. It has value only because everybody thinks it's a valuable thing. So if you live in the US, you know that you're going to have to pay taxes, and you can do it with those little green bills. Now, let's think about what kind of money actually circulates in the economy. So in the US, there are 3 very different currencies that trade at par, and that we view them as being interchangeable. So first of all, there is physical currency. There are the green bills. So physical currency is essentially an IOU from the central bank to consumers, to all of us, and we accept it because we think that the central bank will not fail. In addition, there are central bank reserves. Those are the IOU from the central bank to commercial banks. There is a sort of wholesale money. So consumers can actually access central bank reserves. In addition, there is effectively private money. So this is commercial bank money, and it's an IOU from banks to consumers. So let's make that a little bit more precise. If you have money floating around, you probably have a bank account. Consumers who have cash, they put it in a bank. What does the bank do with it? Well, banks don't keep all that cash in the vault. So with banking, we have a fractional reserve banking system. And what that means is that you put $1 into the bank, and the dollar doesn't stay in the bank. Rather, the bank takes 70 cents of it and lends it out to make more money. So now, what happens to that 70 cents that you lend out, the bank lends out? The person who gets that money doesn't spend it on the day that they get it. Typically, they redeposit it into the bank. So what happens is that you deposit $1, and right after that, there is $1.70 floating around. So you think you have $1, the person who got the loan has money, and essentially the bank has created a value out of the thin air by giving the person who received the loan a demand deposit. So there is a name for that, and we sometimes call it inside money. So most of the money that we see in circulation, that I have, that you have, that everybody has, is in fact privately created by commercial banks. So now, how do banks exactly plug into the payment system? If you think about two separate banks, each of whom has consumers that bank with them, at some point, the consumers at each bank are going to have business relationship with each other, and they're going to either write checks or swipe credit cards or do something, and the banks are essentially going to owe each other money. So if one of the blue people on the left writes a check for the orange person to the right, the orange person will deposit it in their bank account, and their bank is going to demand money from the blue person's bank. How does the interbank payment system works? Well, there are various interbank wholesale platforms that only banks typically, or any other regulated entities like them, have access to. But that allows them to transfer value throughout the course of the day. One of them is called Fedwire, but it's certainly not the only one. So another one is called CHIPS, and this is actually run by a consortium of banks. Accessing those rails is also not free of charge. There is a cost associated with it. And there are also a collateral cost. And the collateral cost comes about because the amount of money that slashes through the system on a daily basis, it's much larger than the reserves the banks have at the central bank. So there is always to worry that one bank will go down, and again, to be a source of systematic risk. So the thought that I want to leave you with after this lesson is, what does a bank do? So we talk about banks throughout this whole lesson, but what does a bank really do? So the banks provide a bundle of services, and they do at least three things. So they provide storage. So if you have money, you don't necessarily want to keep it under the mattress, right? So you're quite happy to leave it with a bank. So once your money is there, it's very easy to use a bank to process payments. So they're important to transfer value. And once they have your money, they quite know a lot about you. They know your income, how much money actually is coming into the bank account. They know your balances and so forth. So banks typically also offer a whole suite of financial services now that those things have been all bundled. So the fact that they are bundled and there is such a thing as a bank makes life much easier for regulators. One entity is easier to regulate than multiple different entities. And if there are any spillovers between the different functions, such as storage, payment, processing, and so forth, then the regulators can force banks to internalize those spillovers as opposed to having to think about each individual element and how it's contributing to the system as a whole. One of the promises of DeFi is the ability to unbundle those traditional financial institutions and hopefully to make a better system. So that's all I had for this session. Hope you learn a lot. Once again, if you have any questions, please reach out to me. See you at the next session.